I don't want you guys to do is listen to the news and think that real estate's dead, that you have no opportunity to go out there and create wealth, because all those things still exist today. What's up, guys? Your agent Tyler Wehrung here, and today we're going to talk about the big rate hike that everyone's talking about, and it's sounding like the world is getting ready to end. So yesterday, the Fed did increase rates by 75 basis points, or said differently, 0.75%. This is one of the biggest rate increases we've seen in quite some time, and really this is somewhat needed. Our economy has way too much money floating around in it. We just came out and saw that inflation's at 8.6%, which is a historic high as well. So the government really did have to do something. But today I want to talk to you guys about how this impacts the real estate market, HELOCs, your mortgages, all things real estate finance. So with that, let's hop over and take a look at my screen, and we'll talk about the specifics. All right, as you can see here, just a quick note, this is kind of the typical gloom and doom things that you see out on the news. We got a sad guy here with his daughter, wondering how they're gonna pay their bills, trying to do the math on their calculator and such. No, so while this is a significant rate hike, come over here to Freddie Mac's website, look at mortgage rates. This is typically where I go to for my source of where rates are at the moment. And as you can see that from last week, we were at a 5.23%. We've jumped all the way to 5.78. So while the Fed fund rate shouldn't actually impact mortgage rates, typically mortgage rates follow the Treasury rate, the 10-year Treasury. However, these are all interconnected, and so it usually ends up rolling downhill and impacting all of the rates out there. So as of June 16th, the 30-year fixed rate mortgage, FRM is what they're referring to here, is at a 5.78. That is quite the increase, as you can see. So if we look at a year ago today, we were in roughly the 3% range. So from 2.98%, we're all the way up to knocking on 6%, guys. This is a big deal. And let's talk about how we think it might impact the real estate market in general, or the overall affordability index of folks out there looking for homes. So I'm going to use this Google, I just Googled mortgage calculator. Typically Google pulls one up here that you can check out. You can look at it by what you want your monthly payment to be when you click here, based on a loan amount, a 30-year fixed rate, and it plugs a rate in here. Or you can look at it from a purchase budget standpoint. And so for this discussion, I do want to start out looking at it from the purchase budget. I think 90% of people kind of go out and look for a home in the range based on the budget that they can afford on a monthly mortgage payment. All right, so let's see what the average income All right, so the average household income in the United States in 2020 was $67,000. If we just assume 3% raises over those last 2 years, because the Census Bureau is a little bit dated, let's just call this number 70,000. So we'll go over here and put in 70,000, and then we'll use the rate that we just found over here for the federal or the fixed rate mortgage. So 5.78. Let's call 5.78. On a 30-year fix. And then I also did go and research what the average down payment is. Usually it's between 5 to 6%, or $10,000 to $15,000. Let's just assume $15,000 for this example. And so this pretty much tells you your purchase budget. Obviously there's a lot of factors that go into how much you can qualify for a mortgage based on what other debts you have associated to your personal name and what kind of overall financial position you have, credit score, etc. But for this example, let's just use it for conversation's sake. Let's say your purchase budget is $248,500 or $250,000 is what the average American making the average household income could afford. And so now let's come over here and look at the Zillow Home Value Index. This is what I use to really look at what what the value of homes, or what homes are going for across the United States. This is kind of difficult to look at because real estate is so geographic. So a house in California is a lot different than a house here in Ohio where I live. But if we look at from across the United States, Home Value Index says the average home is $350,000. So we're at a $100,000 difference between what the average household can afford and what the average home is selling for. I do like to kind of track this metric of what the average family can afford and what the average house is selling for. If we look at 1 year ago today, this was in a much better ratio where we were at, like I said, let's call it 3%. And the home value index a year ago, let's call it, was 295. So let's go ahead and put those in. Just call this 3%, and 295. So they were pretty much at a 1-for-1, so that the average family could afford a $300,000 house, and then a year ago they were going for roughly 295. So that's a pretty healthy ratio. And again, this is across the United States. I'm also going to look at specifically my state here in Ohio, what things are looking like here, and you'll want to do the same for your local market. So you also have to go out and find average household income Ohio. That's at 58,000. So we'll adjust our numbers here. 58,000. We'll see what it is currently at 578. In Ohio, the average household should be affording around a $200,000 house. And let's see what it is for, so roughly right at 208 is where we're at today. So that's a much closer in range, or close ratio to where you would like to be, where the average family can still afford the average house that's being sold on the market. So what does that all mean? Those are just kind of benchmarks or things that I like to keep a pulse on. But again, the problem with the current housing market is the supply is so slim that we're not just dealing with the average family out looking for the average home. We're dealing with people who do make high incomes, who are willing to pay much more than market value to drive these prices up and get into multiple offer situations, which has kind of caused this whole market to get out of control. Also, that coupled with the very low interest rates we were just seeing a year ago made it get completely out of hand. So all that to be said, I don't think the housing market is really going to start to go on a downward trend. I do think that things will start to slow down. We won't see it increase as much, but with sky high inflation, the values I think will likely continue to climb, and we'll just see a much healthier relationship between buyers and sellers in the market to get closer to that equilibrium or that 6-month supply that we typically like to see in a healthy real estate market. All right, so also, as you guys know, I'm a big proponent of the HELOC and using the equity in your home to go out and take advantage of opportunity. So this does impact the HELOC or the home equity line of credit. And as you guys know, I always say that I'd like to kind of only keep a home equity line of credit out there on things that I think I can pay off within 12 months. 6 to 12 months is typically my time horizon. And this is an example of why I like to do that. When you do use home equity, it's a variable rate interest rate. So, when things like this happen, you're likely going to start paying more for that equity that you're using. So if you do have an open HELOC, you likely will be impacted by this. However, it's usually a 60-day delay from the time that rates adjust to it actually hits your billing cycle. So if I were you and you do have a home equity line of credit open right now, I would spend some time today trying to figure out how you can get that paid off or refinanced or restructured, because you likely have 60 days or 2 billing cycles before you're starting to pay that higher rate. Now, if you're in a project or a flip or something like that where you're going to make a decent profit, this likely isn't going to impact you a whole lot. And if you were paying, 5% before and now you're at 5.78, you're likely talking about an extra $100, $150 a month, depending on how much that you have out. But this is more for the folks who have taken a line of credit out and went out and purchased a home or put a down payment down and are using funds from the cash flow to pay that back. You likely want to think about a different way to get that paid off sooner, because you're likely going to be paying very high interest on that variable rates. And I've been getting a lot of questions about how this does impact current homeowners out there. And so just want to clarify this. Now, if you do have a current fixed rate mortgage, which is something I always recommend, 30-year fixed rate mortgage on long-term debt, this won't impact you at all. The whole point of a fixed rate mortgage is you fix the rate. You lock that in and you get it for the full duration, the full 30 years of the whole note. So no matter what the market does, it protects you and keeps that locked in. This is where variable interest rates kind of get a little scary, because you're subject to the market, and your mortgage can adjust and fluctuate with whatever the market decides to do. So with all that being said, and again, I will acknowledge this is a much higher rate increase than I previously speculated. So I think myself, I'm surprised, and a lot of the folks I follow, everyone's kind of shocked by what they're doing. However, I can't argue with the reasoning behind it, as in we're just in a crazy time right now, and they have to do something to try to dial things back a little bit. bit. But with all that being said, nothing really, the fundamentals don't change with real estate investing or going out and looking for a house in general. You just have to plug this in. Most of real estate is just a math equation. So this is just a new piece or a new factor that you have to plug into your equation. If you could previously go out and purchase something for 100 grand, this might now knock your offer back down to 90. It's just a numbers game and you have to factor this in. If you know you're going to be needing a HELOC or variable rate debt, want to take down a project to flip or use this hard money for a certain amount of time, just give yourself a little more buffer when you're making these offers and maybe assume it's going to take you a little bit longer so you have that cushion built in. But what I don't want you guys to do is listen to the news and think that real estate's dead, that you have no opportunity to go out there and create wealth, because all those things still exist today. You just have to open your mind and think about how to go about doing that a little bit differently, or to give yourself a little more cushion or wiggle room as you go out to do that. So guys, I hope that was helpful. Try to stay positive. I know the news and everything's trying to beat you down right now, but take it with a grain of salt and try to just read through the noise. Think about how this will impact your situation and adjust your strategy accordingly. If you got any value out of this, guys, a like or subscribe would always be greatly appreciated. But with that, guys, I'm Tyler Wehrung, and we'll catch you next time.